7 traits that all great options traders possess. That's our topic today. So stay tuned for the Brew with Lex and Molly. Good morning, Mal.
Coming to you live from the Brew Wednesday morning.
I love it. Look at the new background. Wow, pretty cool. Don't you look
Let me
swanky.
Vanna it. Let me Vanna White it for you.
That's very good. Awesome. I love it. I know you can change the background, so we'll mess with that in future episodes. I love it.
I know. I think we need to put your sweatshirt back there next time.
You like this one?
I'm loving it.
Awesome. Okay, so let's get to it. What do you say? So
what's on tap for today?
Today's show, the 7 traits great option traders possess. Okay.
Great.
So there are definitely more traits that great option traders possess, but I've honed in on these little hotties, these 7 hotties. Love to hear from folks what they think, if they're legit or not, but we'll see. I think they're good. And I would also make a caveat that these traits probably are more pertinent to the off-floor retail type trader as opposed to a professional, market making on-floor guy. So, that's what I'd say about it.
Cool.
How do you feel about those apples?
We need these. There's 7.
It's all about discipline, Ma. I say that so much. I can't be a broken record enough when it comes to off-floor trading.
Hey, Lex, just a quick question. Is this like 7-minute abs?
You know what? When you're done, you're going to feel it. I think you're going to feel the abs when we're done.
There better not be a discipline slide in here. I'm telling you right now.
There's a discipline slide for sure. All right. You ready?
Ready.
Trait number 1. These are boring, by the way, but they're true. Trait number 1. Find a strategy that suits your personality. For example, buying premium versus selling premium. Let me explain, Lucy. Let me explain. Okay. So what does this mean? When I first went to the trading floor 150 years ago, I discovered that there are 2 main strata of strategies. One is buying premium, which means buying options, okay? And one is selling premium, collecting it or selling those options, right? The difference, buying options comes with negative theta. So your portfolio in a long option, long premium state will decay every single day. You'll lose little bits of money, chunk by chunk by chunk. And if you can handle that sort of behavior, wonderful. Now, what's the upside of that strategy? The upside of that strategy is you're going to get a big move one day and it's going to be, woo, all the chips coming. It's like playing a slot machine a little bit, lose, lose, lose. Oh, I hit one. Woo. Right. Now, I don't want to make it sound like gambling. It's not. I think that some people love this strategy. I find it difficult. That's not my personality. Conversely, selling premium, you're collecting theta or harvesting it, right? That to me is a little more sensible because every single day you're pulling that theta in, you're collecting a little bit. And then one day the slot machine's going to hit against you and you're going to pay a little bit up. Now, you have to have discipline, of course, in any of these strategies to know when to bail. But you got to figure out something that suits your personality. And I finally did. I did the wrong personality first. I was like Sybil. That's a really old reference, isn't it? No one's gonna know what that is.
Oh, it's a good one.
Yeah. So I was like Sybil. I started buying premium. I thought that's the way to do it. That's what my backer taught me. I sucked at it. I lost money. I went crazy, and I jumped to the other side of selling premium. Once I sold premium, figured it out. Again, massive risk management with the selling premium as well. And it just kind of came naturally. It felt good. It made money every day. Friday came. The weekend is 2 days of decay. Lovely. I make a little bit more money over the weekend, and everyone's happy until you get your big move, and then you throw everything all over the office.
Right. And to speak to that growth that you from when you were a novice to the pro that you are now, can you somehow learn those lessons in a virtual, simulator? Can
Sure.
you
Good question. Good question.
what, what
Molly,
options do
Molly is on fire this morning.
you
No, that's a good question. Yes, you can. So that's a really good idea. I know we at Tradier and TradeHawk has a virtual trading system. So if you download the TradeHawk platform, you can get into virtual, or I call it paper trading, and you can create fake positions. You'll get fills. It's not going to be reality. It's 15 minutes delayed data, but great place to practice. So then you can hone your skill there and try to figure out what suits you best. Are you
right,
a premium buyer or a premium seller? Okay.
right.
So that's a good question. Yes, you can do that, and I highly recommend it.
Okay.
With a
But
with a little
I
bit of a caveat there, to an asterisk. Don't use paper trading as if it were real, because it never will be. You will never have the mindset of a real trading environment in a paper simulated, because it's not real money. Only when
right.
it's money and you can fall off the bike without the training wheels and skin your knee will you know the difference.
Real
Who's
money is a
out there?
visceral right. Real money is a visceral education.
Sure is. Do it for real.
All right, number
Practice.
2.
Yeah,
What do we have number
practice.
2?
We're at number 2. Let's go to number 2. Number 2. Make trading your business in terms of gaining knowledge and following a plan. Never stop learning. Okay. What does that mean? I know people are going to say, well, wait a minute, Lex. I have another business. I'm a doctor. I'm a lawyer. I'm an accountant. I'm whatever. I have a business. I go, exactly right. Make the trading part of it your second business then. And what I mean by that is you don't have to sit in front of the computer for 6.5 hours every single day, or 10 hours. But what you need to do is actually put in the time to understand exactly what you're doing and know all the minutia of trading options. It's very, very involved. There's all kinds of stuff to learn. Never stop learning. I still watch videos online to this day, and I've been doing this for 37 years now, I think. Okay. So I never stop learning either, because things, actually change. So when I always want to hear another person who has had success talk about a strategy, talk about what he or she is doing, maybe I can learn something else to enhance my ability trading. So that's what I mean by make it your business. Does that make sense?
Yeah, and then if it's your business and you have an expertise in a certain area, fundamentally trade the stocks that are involved in that sector. And that
Sure.
gives you a huge edge. And then, I think the technical term for this is side hustle. That's what
Oh,
that's a technical.
that's
So,
a technical term, side hustle. Very good.
yes, and I will tell you with what the feds are doing, it's a good idea to have a side hustle in your back pocket, be
Yep.
safe, and trade what you know.
I-
Start there.
Yep, exactly. Okay. Trait number 3. Don't have FOMO when trading. If you miss an opportunity, move along. Do not chase it. What do you think about that?
Okay, now just for some of us, break out that acronym, FOMO. Not all
Oh,
of us know what that is.
okay. So FOMO means fear of missing out. I've got a
Okay,
great friend who has FOMO to the nth degree. He, never wants to be out of town when there's a big party, right? Doesn't want to miss it. That's
all right.
FOMO. In trading, I can't tell you how many times this has happened to me. It happened to me yesterday, as a matter of fact. I put out an offer. I don't get it. It kind of moves along pretty handily, not to where the place where I wanted to get in. I don't chase it. I look for another opportunity elsewhere. I leave that one alone and move along. I missed it. It's over. I missed out on it. I didn't get invited to that party. Forget about it. Move along, find something else. And if you don't find something in that day that you're looking to do, so be it.
All
Right?
right.
So be it.
When
Um,
you're waiting for positions to get filled, do you have any backup? Like, do you have some backup moves that you make just in case you don't have an immediate fill?
no, I think I'm talking more about opening a trade versus closing it. Now, closing is a different story, right? So that's a good point. Closing a trade, that comes into the risk management part of things. Let me get to that later.
Okay.
So someone said trade like a robot. Yeah, I would say the difference between what I did on the floor, and this is a good point. I'm glad this person brought this up. The difference to what I did on the floor versus what I'm doing off floor now as a retail person is massively different. Okay.
Got it.
you have to have some roboticness to you off the floor. You have to have a trade plan, a pattern. It's got to be disciplined, and you got to stick to it. You could make mistakes on the floor because you're always buying bids and selling offers, especially on a busy day. So you don't have to be so robotic on a trading floor when you're a market maker, because you have edge built into the bid ask. So even
Right.
if you're long premium and you're theta away, you're
Right.
bleeding theta. It's like skin melting off your body, right?
Right.
You can still trade to overcome it and at least neutralize the loss every day, right? And that's why market makers, floor traders could afford to be long some premium, because they could fight against it. Off floor, way different. I like that robotic sound. I don't want to make it sound negative. I hope it's not negative, but being a robot, man, you be a machine. You just keep grinding and just do that, that thing that works for you, and stick to it.
And you
All
get into
right?
that crumb collection business, which is
Collect the crumbs. All right.
Yep.
Ready for number 4?
Let's go.
What is this one? Don't buy deep out of the money calls and puts naked. Wear clothes. Nothing naked. Okay. So what that means, okay, and notice I stress naked, okay? So deep out of the money calls and puts are only for risk management. What the heck does that mean? First of all, what is a deep out of the money? That just means it's way out of there. So what I see a lot of retail folks doing is they buy those little 15 delta calls and puts thinking they're going to hit the lottery and they're going to win, and it's going to happen. Now, someone's going to say, well, Lex, what about GME? Remember when it was $15 and it went to 500? Yeah, great. That's once in a blue moon. Okay. You're going to lose the whole rest of the time. And you have to have great timing to have these things anyway.
Yeah.
This is a recipe for losing money consistently. Okay. Now, I want to stress something. Deep out of the money calls are great for the clearing firm. They're great for your risk manager's office. Why? Because all of a sudden, if you're naked short stuff and you buy these deep out of the money calls and puts to offset that, it makes your risk graph look flat and have a defined risk strategy. That's for the clearing firm. We even did it in the pro side. We'd get risk calls all the time at our firm, and be like, hey, you guys have upside 20% risk and downside 15% risk. Can you clean it up? Oh, yeah, sure. Guess what we go do? We go buy these stupid things we know we're going to lose on. And we lose on them for sure, but it makes everyone happy because now the risk looks like it's mitigated. Okay. And so don't buy them naked. You can use them to offset short premium in the middle. That's when you use those out of the money, those deeper out of the money options. Just like in an iron condor, you got to buy something, right? So you buy something that's farther out to offset the shorts that you're selling in between, right?
That's not the gamma hedge that you were talking about the other day, is it?
No.
Okay.
This
Explain. We won't dive off to a deep end, but just quickly explain what that is from a market maker's perspective.
Yeah. So what gamma hedging is to a market maker is market makers are always, or not almost always, delta neutral. It means they don't take a directional bias. Okay. So when they have gamma on their books, negative or positive, and the underlying moves, it's going to cause their delta position to change. Okay. Sometimes it changes, adversely. Sometimes it changes in their favor. And what they tend to do is either side, negative or positive, they tend to sell and buy deltas from the gamma movement to make that delta position back down to neutral. Now, are they doing it every tick? No. Are they doing it every dollar? Not necessarily. The pros do it. It's very systematic nowadays, and they may even do it based on time of the day too. So they may not do it every n number of dollars and cents that the underlying moves. They might say at 10 o'clock in the morning, we're going to hedge our portfolio from deltas from our gamma movement. So that's what gamma hedging is, right?
Okay. And
pretty tough to do in the off floor world. Look at, if you put a position on where you're long gamma and you got to scalp the underlying because you're getting long as the stock goes up and short as it goes down. Okay, fine. Try to fight that negative theta. I'm okay with that. So that's what that means. But this last one, which was don't buy deep out of the money, that's more a risk management tool, those deep out of the money options. It's not a starting strategy naked. And what I mean that is you buy a deep out of the money call or a deep out of the money put, and that's it. Those are considered lottery tickets, and those are
unlimited risk
most of the time.
I think that's where people get confused about options, where they say, "Ooh, options, so dangerous." But there's another side to it, and that's, I think, the side that they're referring to when things have bottomless pit risk.
Yep. You got it. Okay, ready for trait number 5.
All right.
Lose like a pro.
Lose like a pro. Wait, is this a life metaphor?
This is a
What are we
life
doing here? Are we
metaphor.
still talking about options?
Yes, the greatest traders know how to take losses. It is
Yeah.
part of the game. So, lose like a pro. Embedded in that is, I can't tell you how many times you have a losing day or situation, especially on the
Yeah.
trading floor back in the day. And I had tons of edge. I could buy bids and sell offers. I keep saying that. So there are times when it just doesn't go your way, or the market does something unusual, or you get pinned with too much risk, and your losses start to pile up.
Yeah.
The trait 5 kind of points to, don't throw good money after bad. Okay. It's better to take the loss and move on. Okay. So in your trade plan as a retail trader, you really have to have pretty set places where you're going to get out of the position because of the loss. Okay. And I do it. I have them. I have my own parameters. And when it hits it, I'm like this robot. Look at, am I automatically taking off? No, there's a little finesse around the level, and I kind of goose it a little bit, but after a point, I'm like, uncle, boom, take my loss, move along, live to see another day. And I'm truly not taking max loss at all. I structure my losses so that I'm taking 8% of max loss. Okay, so if I can lose $500, there's no way, unless the market stops trading and opens up at a new price, that I just can't get out. But as long as I'm in the trading part of the day, I have a number of a max loss, and it's generally around 50% of max loss. Okay, because I like to take 50% on the other side, but I put trades into my favor that have a high probability of winning. We'll talk about that in a second. All this makes sense?
Yeah, and just on this note, you had a 3% risk. Can you just talk a little bit to that?
What do you mean I had a 3% risk?
You had a 3% risk threshold. That sounds low, obviously, but there
Yeah.
was
No,
there
well,
was like
yeah. So I think that you might be referring to what I like to risk
standardization or something. Yeah.
what I like to risk of my total equity on any one trade. Maybe that's what
There
you're.
it is.
Okay.
Yes, that's it.
Yeah, look at there's a lot of metrics out there. I think most people who are pretty good at this tend to be in the 2 to 5% range. So what that means is, let's say you have a $10,000 account, right? So 10% is $1,000, 5%, 500, et cetera. So on any one combination trade, right? They don't want to have a max risk that's more than that 2 to 5%, $200 to $500 in our example. Okay, which is good. That's good. That's good money management. That makes sense.
And
right?
what's your sector spread? Like if you were going to really stay disciplined, let's just a couple of items on your portfolio. What's too heavy in one sector?
Yeah, I tend. So what I like to do is I like to keep it simple, right? And what I'm looking at mostly now, since these 0 DTs, I talk about this all the time, especially with the guys tomorrow. I like to trade the SPX on a daily expiration basis, so the 0 DTs, right? And that's another show altogether. But the gist of it is I can sell premium when it's high, and I only have 6.5 hours to live, and I technically don't even have that long because I don't do them at the beginning of the day. So that's what I like. I don't have to think about sectors there. I just think about the overall market. The overall market can't have a takeover. The overall market can't have a take under, although you can have big moves. Granted, we've seen big moves upside. But unlike a stock that can have a binary move based on a news event, those, I tend to steer away from now. I got to be honest. I tend to trade the indices. Now, that doesn't mean that I wouldn't trade Apple or I wouldn't trade Tesla. I certainly have opinions, and when I have an opinion, I'll put on a trade or a spread to take advantage of my opinion.
So
okay?
indices,
I'm not very sector based, and I know people are, which is great. I have nothing negative to say about that. If you understand those sectors, that's awesome.
So indices and ETFs, do you do those a lot?
Yes, all the time.
Okay. All right.
I love it. Oh, hang on. Okay, this is a tough one. Ready for number 6?
Yes. Oh, by the way, before 6, I'm just gonna get a little double X chromosome here, and I just want to say that part of, losing like a champ is to not lose at all. There's always we're always pushing towards that.
Yeah, you're. I mean, someone's been undefeated.
And I'm going to say, I will see, you're right. Someone out there, I will say this, that when you're trading, distraction, in your life is actually a big component to staying focused. And
Right.
so when you
You know what
trade,
I do?
yeah,
What I do is when I find myself glued to the computer,
yes.
I unglue myself. You know how I do that?
How?
I get a Starbucks where I go work out. Just get away from that computer because it's
Okay.
like, sometimes you're like this watching paint dry. I mean, you can't be like that. So
But a lot of
I
people
don't sit
have,
there, I put my position on. I know where my outs are, profit
yeah.
stop, and that's it. I don't. Why
I
do I
think,
have to look at it for? It's just gonna make me nuts.
and I think on the other side of that coin is that a lot of people have 1, 2, 3 jobs and they're trying to do the side hustle. So that
100%.
distraction factor, trading will actually help you clean up your life. And even the people you associate with, this is just for Christmas, so let's get gooey. To the
Let's
people
get
you're
gooey.
associated with, if they're pulling you and distracting you, create disciplinary components on, okay, this is shame, first time, shame on me, second time, whatever that saying is.
Yeah,
Shame on whoever. So
I
I
like
think
it.
distraction, clean up your surroundings so you can stay focused, and it's not a bad thing.
Right, right.
Let's
Very
get
good, Mal. Are you ready for trait number 6?
let's go.
We got 2 more to go. This one's a tricky one. Okay. Trait number 6, understand reward to risk ratios. And I like to shoot for 2.5 to 1. We're going to explain this or more on trade setups. Define risk strategies only. Okay. I got an example here. So, first of all, in the retail trading world, you probably don't have enough money generally to sell options naked. Okay, I'm not a big fan of that. That caused my biggest loss in my history, because I wasn't, fully risk managed. Very difficult off floor as a retail person to not have protection. Okay, so defined risk strategies are butterflies, iron condors, right? Broken wing butterflies, credit spreads, put and call credit spreads, debit spreads. Everything has a defined risk. It has a max loss, not infinity. When you see the infinity sign, bad news bears. Okay. Now,
Right.
look if you had an infinity sign on the reward side, okay, I could see that, right? That's okay. That's probably going to cause you to be long premium and paying theta potentially. But there are ways around that too. You can set up strategies that you're long units and collecting premium too. There's ways to do that. So let's take an example. I have an example here of a reward to risk calculation. So as I said, I like to do these iron condors in SPX 0 DTEs. I don't do them all the time. It depends. And that's going to point to trait number 7 in a second. But let's assume that there's a 96% chance of a 60-cent reward or a max profit. So at 60 cents, one lot, $60. Okay. In options, it's times 100. There's a 4% chance. If it's 96 chance of winning, there's a 4% chance of losing, and your max loss is 440. So if you see the 60 and the 440 added together, that's $5. Sounds like I have a $5 strike spread on of some kind. I sold this for 60 cents credit, okay? And I can lose the difference between $5 and 60 cents, which is 440 in this example, okay? Do we make this trade? Do we do this trade? Okay, all things being equal, meaning what I mean by that is there's no news coming out in the underlying, there's not a
Right.
earnings event or anything like that. Okay. Now the way the math works out is you do the reward on the numerator and the risk in the denominator. Okay, 9.96 times 60 divided by the quantity 0.04 times 440. So that ratio, I'm not going to do all the math for you, but I think it's 57.6 on the top, 17.6 on the bottom. The number ratio comes out to 3.27. Which is obviously greater than 2.5, my minimum number for me to do this. Okay. So I've got a 3.27 here. This spread looks good. Okay. This is something I would consider doing. Now you say, well, you can only make 60 cents, but you can lose 440. That seems like a lot. What a terrible trade. Well, we just did the mathematics of it, right? And what's going to happen is if you do 1,000 iterations of this, you can multiply 1,000 times 0.96. You come up with 960 days where you're going to make the 60 cents, multiply that out. Same 1,000 days, you're going to have the remaining 40 days, I think it is, and you're going to lose 440. Add those numbers together, the loss in the game, you're a great winner on that.
Right.
Great winner. Do
And
a million, do 100 days, do 10, any number, you're going to come up with the same mathematics. Now, there's a big assumption here. Is the math, is the 96% correct? TradeHawk gives you those percentages. A lot of systems give you those percentages.
Yeah.
So there's places you can do that. I would always say in the past as a floor trader, I never look at this stuff, right? Because I'm too busy on the floor buying bid, selling options. In this world, I'd say this is vital, right? And I use the what if, which is a risk analyzer tool in TradeHawk, to check these numbers out. I want to have these values. And I've gotten pretty good at this so that I can see the numbers. I don't even do the calculation anymore, right? Because I kind of know when they pop up, where they're going to be roughly. I mean, obviously, if I have an 80% chance of a win and it's 60 cents and, a 20% of a loss, I'm like, that's not going to be good. It's not going to be over.
Right. And anyone who's just jumping in, don't be frightened, because like Lex said, a lot of these programs will calculate those for you. The idea is to follow Lex and to see what his parameters are, and to make sure that number in that box equals what he's telling you. Yep. And so just to, as an analogy of protecting yourself, you've got, let's take a caller, right? Yep. So it's a great analogy where, let's say the underlying stock is a house, and instead of living in that house, you go rent it out to someone, and that is selling a call. And so you collect the rent, which is premium.
Yep.
And then that's too risky. So you go buy home insurance, which is buying a put.
Yep.
And therefore you have nice little monthly income, weekly income, and then it's all insured. So options are this incredible tool. If you just are getting in and you are a little nervous, this is the place you want to start.
Yep. Yeah. And these 7 traits, I said earlier at the top, these aren't the only 7. There's they go on forever. These are super important ones, though. I think if you can kind of master this group of 7, you're on your way. Yeah. So super important. Good points, Mal.
And, good. This is great for all of us sitting next to you. Is that I think they did upload a snail's consciousness into another snail, so we're good. We can just mind meld you in a couple years.
Oh,
and
okay.
Yeah,
it sounds AI-ish, but I like it.
Skip these slides.
All right, last one, and then we got to go.
Right.
Ready for trait number 7? Here it is. Have a solid understanding of implied volatility. Okay, you should look to sell expensive premium and cleverly buy cheap premium. Of course, I couldn't just say buy cheap premium. I had to say cleverly because there's a caveat there. What the heck does this mean? Implied volatility. All right.
And on trait 7, are we talking, is this dating advice? Understand implied volatility?
Yeah, I've had some dates. Well, I've been married so long. Before that.
Me too.
That had some implied volatility movement. Yes, indeed. So understanding implied volatility. Yeah, no. Again, in the platform, we have all kinds of volatility metrics and workshops and what have you. Okay. So you should have a pretty good understanding of when implied volatility in your underlying, okay, in the class, in those options is high and low. Okay. Lots of ways to look at it. My favorite way is I like to look at 30-day implied vol. I'll go out to 60 to get a flavor, but I like having my positions at the 30-day level and in. Okay. I didn't have that luxury as a floor trader because you just had to respond to markets and you had things all over the place.
Yeah.
I can define it now. So I like to be 30 days in. Why? I like to sell premium. That's when premium starts decaying about the 30-day mark, and it gets more and more, advanced as the days go by and gets closer and closer to expiration. So that's where I like to do it. So I like to know my implied volatility in my underlying relative to a 30-day basis, give or take. Okay. And again, we're dropping grenades here. We're not doing brain surgery. Get close and understand it, high or low. Go ahead.
And just quickly, because you're talking about zero DTEs. By the way, all you have to do is go to Trade Your Hub, search for zero DTEs, and there's plenty of shows, really interesting stuff. So compared to that, so you're talking 30-day and 0 day.
Correct.
Volatility.
That's the range.
Just a quick.
Go ahead. Sorry.
How do you handle the 2 volatilities?
Zero DT is, I still look at implied volatility. I like it to be, really high. And you can use VIX with SPX because they're derived from each other, right? So I like to look at the VIX levels. I look at the implied volatility in SPX in and of itself for sure, right? So we all know, implied volatility in SPX 12, 9, 10, that's low, right? 8, that's at the lower end. You start getting up to 17, 18, 19, 20 handle, starting to get high, right? Up there. So pretty simple. It's been like that forever, right? We've seen in crashes 40, 40 VIX, 40 implied. I've seen 100, in 08. So you see some crazy stuff. Know when it's high, know when it's cheap. Okay. Now, expensive premium, great place to sell things. You get greater expected moves from higher implied volatility. Okay. So you can put your iron condors and your selling premium strategies way the heck out there. However, the implied volatility is high for a reason. Implied volatility is a future look at what the market making community is anticipating volatility to be. So it kind of looks outward. Okay. So it's your kind of guide to what everyone's thinking implied, this market's going to move. Realized volatility, which is of the underlying stock, okay, is a backward looking thing. That's something historical. So there's an argument of understanding where implied volatility is to actual or realized. And if it's a big spread, implied way high and realized is way low, there might be a selling opportunity, and vice versa the other way. Right. When I'm buying, go ahead, sorry.
No, I was just going to ask you a question about that particular thing. So, when people are just getting into trading, one of their main worries is, the fluctuation of the markets, and it's like they're in a boat and they're in choppy waters and they're scared. Right. So with the VIX and volatility, and explain how those numbers are kind of built. Who's feeding the decision whether it's volatile or not?
So what happens is that there's a whole market making community that's making the other side of what we trade on as retail traders, right? They have highly advanced models, all computerized, what have you, and they are masters at risk management. So when their inventory gets one-sided, they raise price or lower price accordingly, right? So they're always trying to get better and better levels of inventory because they have to trade it so much. So these market makers are responding to supply and demand. Okay. If there's too much demand for options, what are you going to do? You're going to raise your prices. What does that do to implied volatility? It makes it go up, right? And everything's interrelated. If you raise the call, the put's got to go up because otherwise there'll be an arbitrage. So everything has to go up uniformly, and then skews go up, and everything, in that example goes higher. So all of a sudden we have a different outlook because people are buying things and market makers are like, whoa, if I'm going to keep selling this, I want more and more edge. So they raise prices, right? And it's interesting. Firstly, the other way on the buy side, they run for the hills when people are selling everything. They're like, okay, I'm gonna choke on this forever. Lower prices.
Yeah, and interesting enough, 10 years ago, no, let's say, 10 or 20 years ago, when someone was buying real estate, you'd have these real estate agents in their cars with their Thomas guide and trying to figure out, what the value of a home was. Now you have, in the digital era, you have comps, and a house will sell in 4 days flat without even seeing the thing. So I wonder how technology will start to yeah,
you can. I mean, look, you could even
close that gap of a question.
Technology can do things like you could even have scanners. I mean, there's scanners out there that you can scan for implied volatility shocks. We used to do it in the pro side when we were off floor. So there's all kinds of cool little things that you can measure that by, but it's readily available, implied volatility readings and what have you. And we do that a lot in TradeHawk. We show those implied volatilities and compare it to a 30-day so you can see whether it's high or low. Now look there's degrees of high and low, right? So if implied volatility, historical implied volatility for 30 days, saying I'm just making the numbers up, 20, okay? And it's 21. Well, 21's higher than 20. Is that high? It's not high. It's a small percentage over. Now, if it were 41, 21 points over historical implied, I'd be like, something's up or something's, what's going on with implied volatility. So I do a little research to figure it out. Now, the beauty of SPX is, Powell's going to speak. That's what's up. There's no takeover SPX or take under.
You just keep selling that you're only technicals, but I do know you research, and you're a heavy researcher fundamentally, aren't you?
Well, look at that. One of my discipline points is I try not to trade on the day the Fed's speaking or they're going to raise or lower interest rates. That's an outlier situation. Most people know there's no chance they're going to raise, but what if they do, right? Or what if they don't? Whatever it is. That's a news event that all of a sudden takes randomness out of the equation. If we're living in a random world of stocks moving up and down, that I can play. But when someone has an edge over me and knows something about the news or something about a news bit, that's an inside information that I don't have access to, and I can't be in the game when that's happening. So that's the point of all this. I see the time,
then
we're late. We got
okay,
a motor, but go ahead. One more.
also don't trade if you see Larry Fink and Gary Gensler walking into Capitol Grill,
That's
correct?
bad
Okay.
news. Yeah,
All
don't
right.
do that. Don't trade that day. All right. What else, Mal? So 7 traits. You know, look at, put something down in the comments if you see this video. I'd love to hear you know, some of your personal traits if you're a retail trader and active. Tell me about what works for you. We'll love to cover that on a future show. These are some things that I find are inherent in every successful off-floor person. So we will put this up on the Hub and YouTube, and you can come back and watch it. But make sure to subscribe to the Hub. Great place to find all kinds of great content, right?
And stay tuned for Trader's Edge later today. Josh Young, great guest. Bobby and Jimmy will always do a good show, so make sure you tune into that. And then 0DTEs tomorrow with the boys.
That's right. Yeah, we're doing some Vana and Charm tomorrow, among other things. So we got some good stuff tomorrow.
So since you're doing Vana, let me Vana White it one more time.
Do a Vana White it with your new background. I love it. All right, Grinch. All right. I'll see you. Have a good rest of the week, Mal.
Bye, Legs.
Bye.